Have you ever looked at the world of investing and just felt lost? Like it's some kind of incredibly complex puzzle? Well, you're in the right place. Today, we're going to put those pieces together. We're going to connect some really brilliant Nobel Prize-winning ideas directly to how you can think about your own portfolio.
It really all boils down to this one simple, yet absolutely massive question. This is the tightrope every single one of us has to walk as an investor, right? You want your money to grow, you want those returns, but you're also terrified of losing it. So how on earth do you strike that perfect balance?
And that question leads us directly into our first big topic, the investor's dilemma. This is really the heart of the matter, that classic, constant trade-off between taking a risk and getting a reward. It's pretty much a law of nature in finance. If you're chasing those higher returns, well, you've usually got to be willing to accept a higher level of risk. On the flip side, if you want to play it super safe, you're probably going to have to be okay with lower potential growth. It's this constant tug of war that makes investing feel so tricky.
But what if I told you there's a really elegant mathematical way to tackle this? It's called modern portfolio theory, and it even won a Nobel Prize. The huge idea here is this: stop trying to pick individual winner stocks. Instead, the smart move is to build a whole team of investments, to diversify, so they all work together to lower your overall risk.
So that sounds great in theory, but what does it actually look like? How can we see it in action? Well, let's move on and actually chart out this sweet spot. Okay, take a look at this. This curve you see here is called the efficient frontier. And honestly, it's basically the holy grail of portfolio building. Any portfolio that lands right on this line is considered efficient. That means it's squeezing out the absolute maximum return you can get for the level of risk you're taking on. It's the perfect balance. And notice how the whole recipe of the portfolio changes as we travel along this curve. Way down on the left, in the low-risk, low-return zone, it's packed with safer things like cash and bonds. But as you start to move up and to the right, chasing bigger returns, the mix changes. You start adding a much bigger slice of equities, stocks, which are riskier, but also have way more potential to grow.
All right, so we've got the big picture theory down. But how do the pros actually pick the specific stocks and bonds that go into these portfolios? Well, it all comes down to giving each and every company a really thorough financial checkup.
You can think of it just like your own annual checkup with a doctor. For a portfolio manager, a company's financial statements are exactly that. They're the vital signs that reveal the true health of the business, where it's been, where it is now, and where it might be headed.
And in this checkup, there are two doctor's notes that are absolutely critical. First up is the balance sheet. It's really just a snapshot in time that answers a simple question. What does the company own versus what does it owe? Then you've got the income statement. This is the bottom line. It tells you if, over the last quarter or year, the company actually made a profit or took a loss. Simple as that.
Now, those statements are full of a ton of raw numbers, which can be overwhelming. So to make sense of it all, analysts use financial ratios. And the real magic of ratios is that each one is designed to answer a very specific, very important question. Is the company actually making money? Can it pay its bills next month? Is it drowning in debt? Or is the stock a total bargain right now, or is it way too expensive? A good manager uses the answers to these questions to find the perfect companies for their portfolio. Let's just grab one of the most famous ones, the price-to-earnings ratio, or PE ratio. Think of this as the stock's price tag. It tells you exactly how many dollars other investors are willing to pay today for just one single dollar of that company's profits. So a really high PE might mean investors are super optimistic about the future. That's a company a manager building a high-growth portfolio might be very interested in.
Okay, so we've got this incredible portfolio theory, and we know how the pros analyze companies. But let's be real. How does an everyday person like you or me actually get access to all of this without being some kind of Wall Street genius? Well, that brings us to the beauty of the all-in-one portfolio.
And for most of us, the answer is the mutual fund. It's this incredible vehicle that pools money from thousands of people, and then a professional manager uses that money to buy a whole diversified portfolio of investments. It's basically professional management and instant diversification all wrapped up in one convenient package. Now, even with a perfectly diversified mutual fund, you can't get rid of all the risk. The first kind you need to know about is systematic risk. This is the big stuff. Think recessions, major interest rate hikes, global events, the kind of risk that affects the entire market, and there's just no diversifying your way out of it.
The best way to think about it is like an earthquake. When it hits, it doesn't matter how well your individual house is built. The ground underneath the whole city is shaking. Everyone feels it.
The second type of risk is called unsystematic risk. Now, this is totally different. This is risk that's specific to just one company or maybe one industry. A CEO makes a disastrous decision, or a factory has a fire. The crucial thing to remember is that this is the type of risk that you can protect yourself against with diversification.
So, to use our analogy again, if systematic risk is the earthquake that shakes the whole city, unsystematic risk is like a fire alarm going off in just one single building. It's a huge problem for that building for sure, but the rest of the city is perfectly fine. And by owning lots of different buildings all over the city, you make sure that one fire can't burn down your entire portfolio. That's the power of diversification. All right, for our final section, let's pull back the curtain a little bit. Who are the actual people and the organizations that make a mutual fund work, and maybe more importantly, how is your money kept safe through all of this?
See, behind every single mutual fund, there's this entire structure known as the mutual funds complex. And as you can see here, it's not just one person calling all the shots. It's a whole team of specialists, directors, managers, custodians, you name it, all working together. You can really think of them as the professional pit crew that keeps your investment vehicle running smoothly and safely.
Now, right at the center of that team, you have the portfolio manager. This is the driver. This is the person who's using all that financial analysis we talked about to make the day-to-day decisions, what to buy, what to sell, all in an effort to meet the fund's goals and keep that portfolio running on that efficient frontier. But here is an absolutely crucial point, and it's all about your protection. The portfolio manager, the driver, never actually touches the money. That's the job of the custodian, which is almost always a huge, separate bank. The custodian acts as the vault. They hold all the cash, all the securities for safekeeping. And by law, these two roles have to be separate. It's a firewall designed to protect your assets. So we've gone on quite a journey, right? From these big, powerful theories about risk and reward, all the way down to how to check a company's financial health, and finally, to the structure that makes it all accessible and safe for you. You see, every dollar you invest is part of a much larger story. And I guess the real question to leave you with is, after all this, do you feel a little more confident that you know how to read it?